welcome back. On today's episode, I want to explore why your revenue is up but your profit is down, what your profit and loss statement is trying to tell you, and how to interpret the results so that you can make informed decisions and shift the course of action in your business to make sure that when revenue is up, profit is also going up. So you just had the best year ever in revenue and the worst profit year ever. How is that even possible? You're like, I'm making more, I should be able to keep more, but that doesn't just happen by accident. You have to make sure you understand what are your levers and how do you shift your management of expenses to ensure that profit does show up and stay in the business. Now, this is very common. A lot of business owners don't like to admit this, but when they're scaling and growing, they're making investments, they're hiring ahead, and sometimes that just gets out of control. And yes, you do have more revenue, but then you don't have the extra profit to show for. First course of action is to identify that this is a problem in your business, and then we can start to course correct from there. Your profit and loss statement doesn't lie. It tells you exactly where the money went. It kind of whispers at you, hey, we have some trends and issues on spending in certain categories that we might want to adjust. So you just have to make sure you're listening to your profit and loss statement, meaning reviewing it, looking at the numbers, looking at where your money went, how do you spend, and is that still the right place to be spending going forward? So we're going to talk about the dynamics around scaling in this Scaling Business Finances mini series, because I find that a lot of business owners don't understand why this is happening or how they get out of it. And I want to demystify that for you today so that when revenue does grow in your business, you can protect profit and maintain the profitability along the way as you scale. And that means not necessarily the same number year over year on results. It just means potentially the same percentage, but on a higher revenue base, which means ultimately more profit and dollars in your pocket. If you're a business making 10% profit this year and you can maintain that 10% profit next year, but increase your revenue by 20%, that is more dollars that are staying in the business, even though the profit percentage didn't change. So absolute dollars are higher, which is what we're looking for, or even improve year over year. That would even be a better outcome. Let's talk about first, what is the problem that we're having here? So revenue is always what a lot of people like to focus on, but you need to get clarity and celebrate profit, not revenue, because that is ultimately what we're in business to do, is to generate profit. And revenue is just a vanity metric. A lot of people love to throw out their revenue number. And then when I ask them about their profit, they just don't want to say another word because they know it's not good. And we can define not good, depends on what's happening inside your business. I know a lot of owners sometimes hide their pay within their business, or not hide, but pay themselves in W-2. So that's hidden within the owner benefit, is hidden inside the PnL legally as a W-2 employee. And then sometimes they own a building, so they pay themselves rent. So that's going back to their pocket as well. So things might look not necessarily straightforward or apples to apples comparison. So you want to make sure you're careful with that. But what we're looking for in here is that profit. And then is that better or worse year over year? Is it growing? Is it improving? Or are we losing money in certain scenarios? Because at the end of the day, profit is what allows you to be able to pay your team, fund the growth, pay your tax bill, keeps the lights on, and keep reinvesting in the business for growth next year. And there's times in business when we're scaling, we are investing more profit. So let's be really clear that not having profit doesn't mean you're failing. It means that you're probably pouring more into the business to grow faster. And as long as that growth rate is up, then you have the outcomes that you wanted. And then ultimately, when you're done investing on the scaling and growth to accelerate the pace, you will be able to see more of that profit staying in the company. So there's reasons why profit could be varying. We just have to make sure we understand and that we know what's happening inside the business that drove the profit to be either up or down, and where do we want it to be ideally. We should have a goal for a profit target. Now, the profit and revenue disconnect happens when revenue is growing, you have more customers, more sales, more volume, and profit is shrinking because you're keeping less of every dollar because you're spending more on creating those results to increase revenue. This isn't a growth problem. It's just a margin problem, meaning you're spending more to deliver on the same or increased revenue, and it's costing you more to do so because maybe you're inefficient at first because you're scaling and you're adding a lot of costs that maybe don't need to be there long term, but temporarily you need them to accelerate the growth, and then you will grow revenue beyond your fixed expenses that will allow you to have the profit that you're looking for without adding more costs. So that's the idea. And what we want to be looking at when this is happening is like the gross margin, operating margin, and net margin of your business, because those are going to tell 3 different stories and give you different warning signals on what's happening in the company. Don't just focus on revenue. That is not enough. Make sure you're looking at the margins and the profitability so that you can make better informed decisions from there. Okay, also be very mindful of when business is growing, it takes a lot of extra resources. So cash could be tight and it would create a cash crisis if you don't manage that tightly. And it happens very quietly and slowly. So you want to be having a cash flow forecast alongside your growth plan and investing back into the scaling so that you have clarity on how cash is moving while you're growing your business. Okay, now we want to make sure that you spot this ahead of time and doesn't become a crisis that you can't get out of. A few trigger moments that you want to be watching out for and patterns that show up during the scaling of your business. So rapid scaling phase, you're growing fast and your cost infrastructure isn't keeping up pace. And this could be your infrastructure on like how you collect payments. It could be your finance team doesn't keep up, or it could be your operations or your billing team or administrative staff that's supporting you can't keep up with the growth and the pace you're at. So things start to break. So signal to be watching out for, because you will probably try to overstaff on that admin team to deal with the growth, and then your overhead will be way too high for the size of business you are. So again, you just have to be careful to make sure that it's moving along the way as revenue growth and not exceeding where it should be based on how revenue is growing. We look at growth of revenue rate and then growth of expenses rate to see if those are keeping up or they're exceeding each other. Okay, you're launching a new product or service and you really just don't have a lot of data on that. And so you're testing out to see if this is profitable. Sometimes it's just going to take more money to get that up and running. So that's going to eat up some more of your resources and then potentially lower your profitability. So something to keep an eye out for. Maybe you're entering a new market that you haven't explored before or are not established in yet. And that's going to cause a lot of costs in marketing because you probably are not even known in that market and you're trying to make a name for yourself, where before just expanding what you already had in the existing market was a lot easier. So things that will, drive cost up is customer acquisition, and then margins are just not going to be there yet because again, it's a new market you're entering. So it takes time. Competitive pricing pressure. So like winning on price being the lowest is not always the best alternative. So you want to make sure you don't do this at the expense of your profit. If you're doing it to introduce yourself and like get started, maybe that can work. But once you're at scale, that pricing pressure will not go away. So you want to make sure you solve for that with having super healthy margins when you're starting your pricing journey and having a pricing strategy along with that. Which, if you did it wrong at first, you could fix this. It's not a problem. You just have to make sure you identify that and then shift it so that you can have a better pricing strategy that aligns with the margins you're looking for. Another one that doesn't happen to everybody, but if you're acquiring another business and your post-acquisition integration of double overhead, double the resources that you don't really need, really driving the synergies to get those profits back. It's going to be important. A few hidden warning signs that a lot of leaders kind of miss is cash starts to feel tight, and even though revenue's up and you're like, what's going on? Where's the money going? And so you're just spending it faster than coming in. So make sure you're watching out for that timing. Gross margins are drifting over time slowly. So if you look at your gross margins year over year or month over month, you start to see them slipping by like 1%, 2%, 5%. And then before you know it, 3 years later, you're down 30% on margins. That's a problem. So you need to adjust that while it's happening, not wait until it's too late to deal with it. So keep an eye on either monthly or quarterly gross margins. Headcount is growing faster than revenue. So the problem here is that you're paying for people who are not fully producing yet into your business, which is totally fine if you're growing and you have a plan to afford those first 3 to 6 months where people are not fully at capacity or not fully producing 100% of their cost and then some, to make sure you don't run out of money. So like you still got to pay payroll, right? Even if they're not performing. So this is where a lot of the headaches come in with scaling, especially if you're hiring like 5-10 people at a time. It's just really expensive. So we want to plan for that accordingly before we get into that hyper growth. And then discounting, if you're doing too much sales or exceptions or reducing pricing, this is going to impact your margins tremendously. So trying to avoid that. And also at times I see delayed collection cycles or longer cash cycles. So for some of you who maybe are insurance-based practices and waiting for payment, the payments used to come 30 days. Now they come 45 days, 60 days. This is going to create a huge problem on having to pay payroll and not having the money to do so. So watching out on your days to collections is going to be really important here. And then even though your month end close is record breaking, it's still super stressful to look at the results because they're just not where you want them to be every month. So the longer these problems go unaddressed, the harder they're going to be to correct. And also they compound on each other. So you want to make sure that you identify what is the problem I'm having and how do I solve for that. And you want to have this conversation sooner than later. You don't want to be looking at last year and say, what happened? Then it's a little too late. And then you'll probably be further into cash constraints than you want to be. So don't delay. Okay, so we just want to pinpoint on the root causes to make sure that you as a leader understand what's going on. Sometimes this happens totally not in your control and there are external factors that are driving these issues. In some cases, it could be your cost of materials or labor is going up, fulfillment costs are going up, and maybe gas prices and delivery costs are going up. And these are rates that you're taking. So you're accepting those rates and they're just are doing increases and you have to eat up that cost. So that's going to eat into your own margins if you're not increasing prices, if that makes sense for your business. So you want to make sure your pricing is keeping up with the delivery cost to protect your margin. And if you don't know how to do that, reach out. We'll be happy to help you with that. When gross margins start to erode silently, like we said, this is just going to continue to be a problem ongoing if you don't address it right away. So in the ways that we address this, the price increase piece, or we can look at shifting our services to a more profitable, higher margin offer, or creating something new to help offset that. Okay, operating expenses being bloated. This is a common one I see. Like you start to hire more people, make more revenue. You're like, I need more support. I need more staff. And then you start to give out titles and you're like director of this, manager of that. And then that comes with a six-figure salary. So in a small business, you just want to be really mindful on how much overhead you're adding to your overall business that is not revenue generating, right? So that's any administrative support positions, any support staff operations, those types of roles, because you want to be lean and efficient in those, as in the same size of team can manage double the size of company, not have to hire double the staff to double your revenue. So just make sure you're mindful in the relationship there. And then there's like an optimal ratio, of course, of support staff to like the size of business you are. And I see often that tends to be overloaded ahead of time. And that's what's causing you not to have that profit. And then make sure you have the necessary infrastructure to scale, because we just need to be able to keep up with what's happening. And what I mean by that is sometimes it's like the software you use, sometimes it's like the vendors you use, the support staff. Maybe you've outgrown your current support staff abilities and you need to up level and upskill. And either you invest in up leveling or upskilling your current staff, or you find staff that can do better work that is more experienced. And that sometimes is the solution, not always the case. But the infrastructure has to scale with the growth of the business. I often see this falls behind and it creates more problems because then we have to slow down to catch up to fix things that should have been fixed before we started scaling. So just make sure you're ready for that, because things break and it's just going to be areas that you're going to have to make investments to be able to overcome some of that. Okay, so then let's go on to revenue, because I often don't see people talk about not all revenue is equal, meaning not all revenue is good. You can be selling a very low margin product or service and you have no idea that that's not bringing in the profitability that you want to see in the business. And then if that grows faster than a high margin service, then you're just going to create a whole constraint in your business because there won't be enough left to cover all the other costs. So be careful of what you're scaling and make sure that it's intentional and it has healthy margins. And if you don't know what a healthy margin is, book a call with us. We'll be happy to walk you through what that all means for your business and where you need to make a change. Okay, so also thinking about like, what is your customer mix? Who are you serving? At what level? And then the different profiles of customer. Are you high-end customer, enterprise level that pays thousands of dollars, hundreds of thousands of dollars to work with you? Or you're with a small business that only pays hundreds of dollars to work with you? So this is the customer mix you need to look at and decide who are you serving. Of course, one will take more resources than the other. So then you have to manage your cost to make sure you don't end up with no margin on those bigger customers. So make sure you understand what is your customer mix that determines kind of your revenue and your margins. Okay, we talked about discount pricing and like creating deals. Do that strategically and only when absolutely necessary. I think that pricing can explain a lot of value, and if you can capture and deliver on value, you can charge accordingly. I always see people saying like, just charge more, charge double, charge triple. I'm like, for the same thing, and it's the value 2x or 3x. No, okay, well, that's going to be a problem because your customers can see right through that, and they're going to be like canceling within a few weeks, knowing like, hey, or months, because they know that I'm not getting the value of what I'm paying, and there's a disconnect in that. Another issue I see often is like, we try to make these investments expecting this ROI in the future, which is fine, but we want to make sure we have a plan on how we are going to track that ROI and it's actually materializing as ROI. Because a lot of people say, oh, I'm just making this investment. An investment requires a benefit or an output that's positive to your business. So that way, if you know that happened and it's good, that you want to do it again. If you did it and it didn't work, then you know not to do it again or try it in a different way. So you want to make sure you're careful on what you're spending ahead, because you're using profit from the future to pay for something in the present, especially if you're taking out a loan or financing in some way. We also talked about when you start to hire and you are expanding markets, you are making these investments now, hoping, or ideally you've planned for this, not hoping, you will have return or additional revenue generation coming from these investments. And again, make sure you're tracking those outcomes so that you know whether or not they happen. And if they happen within the timeline you expected, often I see we will bring in a new hire and we'll give them like 30 days, 90 days to get up to speed. And then we see that by 60 days, they're not on track. So then we can be like, oh, maybe next time we need to plan for 120 days. And so this is where we start to get really good insight into what's happening, how quickly can we expect a return, rather than just guessing our way through it or gut instinct our way through it. We know with data, okay, next time we need to plan, or maybe it actually got up to speed a lot faster than we thought. And in 30 days, they were fully contributing. Now we know that's how we're going to plan going forward instead of maybe a longer lead time. Okay, so let me bring it all back to where we started, full circle. Revenue is just a vanity metric. Without having a margin discussion and profitability conversation on that, it means nothing to me, at least as a CFO. We want to make sure that ultimately we have a profit. That is what we're going for in business. And then make sure you pay attention to trends in your data. So like when something happens one time, it's not a big deal. When it happens 2 or 3 times and we see a pattern, then we should pay attention, because that's your PnL talking to you. And then making sure your pricing strategy is set up for profitability to ensure that your profits are going to more likely happen. And I see often this is where there's a big gap that we can solve. And then know your margins by product, by customer, by channel. It's important, or by service, that you know, or by location, what's producing the best margins. And then do we want to do more of that? Is that what we want to scale? Do we want to scale a different area of the business? And your margins are going to be able to tell you that. And then when you're making investments, always think about what is the horizon for this investment to make a return to me? What it might look like, an expectation on it before you go into making that decision. And then my job as a CFO, often I say to business owners that we partner with, is not to say no to growth, but to make sure that it's quality growth. Decide what areas make sense for us to grow. That is not going to end up bankrupting you because you scale the lowest margin thing and now we're just running out of money in a problem that is a lot harder to solve than we want it to be. So making sure we identify what are the areas we want to grow, how do we grow them, and how long will that take? That is really where our advisory services come in handy and help you bring perspective to the partnership on how should your business grow. And then also the question we follow with is like, is this something that's exciting for you, business owner? Do you want to do more of this? Because often if the answer is no, then we might not want to do that. I want to go a different route. And once they get excited and they're like, yes, let's double down on that. It has good margins and we're excited about the opportunity and we're ready to pour gasoline and fuel it up, then it's so much easier. I don't have to drag the owners through the process because they're like excited about growing that. And then we can get going and producing the results that we want to see and do more of what's worked. And this is what data does for us as CFOs, is we look at the data and say, what's working well, can we do more of so that we can grow more consistently and sustainably for the business. And this is where we can make sure profit is protected, that we can compensate our teams better, and that we can make that impact we want to make with bigger size businesses profitable and sustainable long term. Revenue growth should be exciting. I'm not against that at all. Like, we definitely always target revenue growth, but it has to also materialize in bottom line results. And this is really the takeaway I want to give you today from our episode. That's our focus. And then if you want to win long term as a business owner, you know you have to focus on profitability, because that's how we make growth happen, is by using the profits to invest back in the business and fast track the way to growth and accelerate, unless you're doing outside sources of capital. If your revenue is climbing, but your profits are either flat or down, make sure you are creating a plan on how you're going to shift that. And if you need help with that, we're able to support that, bringing you that clarity. So make sure you book a call with us on our website at wealthworthwithin.com to get a free consultation with a CFO and really understand what's happening inside your business finances as you got into the stage of scaling or about to scale or are in the middle of scaling and fast growth, so that we can bring you that clarity that you're seeking to make better decisions financially in your business. Until next time, thank you for being here, and make sure you share this episode with a business owner that might benefit from hearing what we shared today. And until next time.